Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Welcome to another Centaur podcast. Today you've got Nick Georgopoulos and myself, Hugh Robertson, and we really want to just touch base on some recent superannuation changes and also some of the end of financial year tips and tricks that we've got to really pay close attention to, because if there's one thing we've seen the last few years, it's sometimes people will sell an investment property or they'll have a high tax income year and they don't really know that there's things that they could do to reduce the amount of tax payable and utilise superannuation in that regard. So we just want to touch off on some quick hitters today, introduce the changes, and then talk about some end of financial year things so that we can make it an even better position for you in the 23-24 year and in future years. So welcome, Nick. How are you?
Very well. How are you?
Good. Very good. All right, let's get into it. Let's start with Stage 3 tax cuts is probably the biggest noise we've heard so far this year.
Yeah,
What
absolutely.
does that mean to people?
Oh, it's jumped around a lot, right? So a lot of people would have been following that, where the previous changes which were announced have actually been scaled back a little bit. So it's good to know, one, what are those changes, what's it mean, and what's it trying to fix per se. So if we go what the changes actually are, we're having a bit of an increase in the current brackets. So if we know in Australia we've got a marginal tax rate, we know the first 18,200 is a tax-free threshold, and then above that to $45,000 in income, it's usually a 19% tax rate. That's going to reduce down to 16%. The tax bracket above that, which is usually 32.5%, is now 30%, and that is increased to 135,000 in earnings. One above that, 37%, that's staying the same. However, the upper threshold for that increases from 180,000 to 190,000, and then from 190,000 in income higher than that, it's remaining the same at 45,000. So what it's really trying to solve is a bit of bracket creep, is what we call it, in current financial years. Basically, providing tax cuts across the board. So it's not only benefiting low-income earners or high-income earners, everyone's getting some sort of tax break in effect. But like we said before, it's scaled back from what the previously announced Stage 3 tax cuts were.
And I feel this is in conjunction with the cost of living pressures that the government's highlighted, saying that everyone's still going to get a tax benefit, but probably for the higher income earners, just not as great as it previously was. And for the lower income earners, it's been pretty good. Do you want to quickly touch on we love acronyms here at Centaur Financial Services, but the LITO and the SAPTO?
Yeah,
quickly
sure.
touch on what those mean to people?
So LITO being the low income tax offset, SAPTO, seniors and pensioners tax offset, essentially providing you a tax-free threshold. So whilst I alluded to the 18,200 being the tax-free threshold, earnings up to a certain point will still be tax-free because you're getting a bit of a tax break back or a tax offset on that income. So currently, the low income tax offset, LITO, is currently $21,884. From 1st of July, that increases to $22,575. For SAPTO, so that LITO and SAPTO, that will both look at eligibility for singles and couples. So to receive both of them, for singles, it's currently $33,088. That's increasing to $35,813. And for a member of a couple each, that's going from $29,783 in income each up to $31,888 in income each. So effectively, bringing that back to what it actually means is that we can essentially earn that money as long as we're eligible for those offsets. We can earn that income without paying $1 in tax.
And that's probably something that our clients, when they're retired or they still want to work, they do sort of say, well, how much am I allowed to earn in income? And that's just employment income and also any investment income, bank interest,
exactly right.
dividends.
So it goes to, so you're also thinking, well, from a structure process, where I'm holding my assets, is it still best to hold a lot of that money in a bank account in my personal name, or now should I start considering holding that inside of super? With higher interest rates, we're going to see a lot more seniors and pensioners actually paying income tax for the first time in a long time, because those holdings that they've got in the bank are actually generating a lot higher interest income, now forcing a bit of a tax bill.
So for all the employers out there, there's probably some interesting news about SG increases. For employees, it's a good thing.
Yeah.
So what's going on with the increase?
Well, it's good for some employees. Some others might find it a bit surprising. So the super guarantee will be increasing from the current rate of 11% to 11.5%. So a bit more in the bank for your superannuation contributions paid by employers. Now, where someone's on a total employment package or total employment cost, that may actually see a decrease in wages in hand, because you may see on a salary offer it's 100,000 including superannuation. So where this may come down to a bit of a detriment for employees is where that total employment package still remains at $100,000, but now the 11.5% is eating up a bit more of the wage that you used to be receiving in hand. So something just to be cautious of, and maybe even have a discussion with the employer around that to ensure that it's not affecting your cash flow. And if it is, you can actually plan ahead for that.
And which is good, because the government's always said, we're trying to identify that there is a retirement savings shortfall. So more in super for people means that they're going to have more at the end. Also means we've really got to, it's becoming so much more of an asset for people earlier in their life.
Yes.
Now that we've really got to make sure it's in the right investment options, and not always necessarily just in that default investment, a balanced option. Whereas for a young accumulator, we might want to be quite aggressive.
Yes.
And for a retiree, we might want to be more conservative. So it really is a matter of, we've got to pay more attention. You've got to tell your kids to pay more attention to their superannuation and really look into it. And I suppose the other thing from there, when we are looking into super, look at the amount of insurance that we've got as well, because insurance premiums have gone up a lot the last few years. So that really also eats at the contributions that go in. So again, just something to look at as we're sort of paying a little bit more attention to super. Now, we use the contribution cap limits. We talk about contribution cap limits all day, every day.
Yes.
So we're quite boring, but this is kind of exciting stuff for us. So what's happening there?
So we've got increases in contribution caps. So if we remember that we've got two different types of contributions, you've got your concessional or deductible contributions, which you've got your employer contributions fall in, and any other contributions you're deeming to claim a tax deduction on, salary sacrifice and such. We classify that as a concessional contribution. Now that cap is increasing from $27,500 up to $30,000 per annum. And we've also got the non-concessional contribution or after-tax contribution, and that's increasing from $110,000 up to $120,000. So with those increases come a lot of opportunity and a bit more consideration to putting money into the superannuation environment. Did you want to go through what you're thinking, where those benefits may come to fruition?
Yeah, I think we've got to look at the timing of contributions. So remembering this financial year, if you wanted to use a non-concessional contribution, you're allowed to put in up to $110,000 in after-tax dollars in there. Just be careful not to go $110,000 on $1, because once you do that, you've now triggered the bring forward,
Yes.
and now you're going to be limited by how much you can put in going forward. We've got some actual fact sheets we could probably share on this as well, to how to actually go into the MyGov website, into your ATO, to see that you haven't triggered anything or done anything as well, exactly, with the carry forward contributions. But heaps of strategies around that. The deductible contributions to reduce if you've got a year where you've sold an investment property. These deductible contributions are amazing to be able to go back in time if your super balance was below 500,000 to really build that up. And that's, the government has nominated 500,000 as that mark. If you're over 500, you can't go back and use previous years' concessional contribution cap limits. You can only use the current years, but if you are below 500, you can. Really them trying to encourage you to build up your superannuation balance, which is a positive thing, so we may as well use it. And I suppose then that dovetails, we can talk a little bit more about that, but it also dovetails in the fact that if you are going to sell something, which is going to have a high capital gain, whether it be a share portfolio, whether it be a asset that you've inherited, whether it be an investment property, let's really give some thought to if we want to do it this year, where we've got our deductible contributions, which will be good, or do we want to do it next year in a year where our tax brackets are going to be more beneficial for us? So again, that's no advice either way. Every client's situation is different, but let's have a chat about that if it's something that's going to impact you. I would think it is important.
Yeah, absolutely. Like with all of these changes, there's going to be the need to just reconsider your current plans on putting extra money into super, selling assets and such, because it may mean that it's actually better to put that excess capital that you've got sitting in the bank account into super before the end of the financial year, because you're going to get a bit more of a tax concession by doing that. As we flow into the following financial year, you may see you're actually paying less tax anyway. So you see greater benefit of bringing that a bit more forward. And like you said, with selling of the investment property, same note, with stage 3 tax cuts, you might actually have a lower tax rate in the following financial year. So it means, okay, well, it might be worth actually considering delaying that sale until another 3 months away, and benefiting from a lower tax rate there. Again, not advice, general information, but it's always just more so prompting that discussion and consideration.
And we've got a budget coming up in May as well. So there's always superannuation changes. So we've got to really make sure for all of our clients there, it's also a form of return. Our only form of return isn't great performance on the investment products that we use and the investment strategies. It's about tax mitigation when we can, minimisation, and really making sure that you've got the right money in the right buckets. And the superannuation changes here, we've got a 350-page guide on superannuation retirement income streams. We're happy to share it with you guys if you want to read through it, but it's pretty important that we start really paying attention to this, and something that we really want to engage more with our clients on, so that we can get the best outcome for you. So anything else we should add on this?
Not specifically. I mean, with those carry forward or catch up concessional contributions, we know that started a few years back now, but we're going to see the first year of the 5 eligible years to utilise the unused concessional contributions. That's going to roll off. So
the 18-19 year?
The 18-19 financial year will no longer be able to be utilised past 1st of July, which might be beneficial, which might not be beneficial, depending on what contributions went in that year. Because remember, on the other side of that, we're bringing into a financial year 24-25, where we've got a higher concessional contribution cap as well. So a couple of changes, which I think does prompt a discussion, things to be cautious of, and consideration should be completed there. But other than those main ones, I think that should be where we leave it for now.
So we've got tax cuts coming in next year, and everyone's going to be a beneficiary of them.
Yes.
If you're on a high income, you're going to get sort of a few grand off in your tax. If you're on a low income, you may pay no tax with your LITO and your SAPTO.
Correct.
If you're still working, your SGC, super guarantee is going up, but make sure you're talking with your employer that they're not going to then dock your pay, because that wouldn't be okay. The higher contribution cap limits are coming in, so let's just be aware of our strategies around them for bring forward and carry forward contributions to build our strategies around there, whether it be tax minimization, Centrelink maximization, wealth creation. Let's make sure that we're being clever with what we do there. And then in maybe a future note, we'll talk about things like the contribution splitting, spouse contributions, government co-contributions.
Yeah.
But I think we'll leave it here for now.
I think so.
Okay. If you've got any questions, shoot them through to us. Thank you very much for your time.
Thank you.
Enjoy it.
Bye for now.